You've just heard about our leading upstream and integrated gas businesses, and I now want to tell you about downstream, renewables, and energy solutions businesses, where customers are at the heart of everything we do. Bringing these businesses together emphasizes our ability to help our customers decarbonize through the energy transition. What our customers need will change over time. Therefore, our focus will change over time. Today, we have leading businesses like marketing, which we will get the most value out of. For tomorrow, we are building businesses such as low-carbon fuels that will allow us to capture attractive growth, leveraging our competitive advantages. And to be ready for the future, we are seeding options in parts of the energy system where we have the capabilities to win. For example, in hydrogen, Wal spoke earlier about our focus on molecules. To enable molecules businesses of today, tomorrow, and the future, we will need access to green electrons, both to decarbonize our own assets and to help decarbonize our customers, especially those in industry and transport. Our optimization capabilities will be key to us successfully delivering this strategy. And we are starting from a place of strength. Our extensive customer reach means we are well placed to deliver more value with less emissions. Let me talk you through how we will enhance the value of our business as we help our customers decarbonize. Our chemicals and products businesses include both chemicals and refining, in addition to trading and optimization of crude and oil products. Over a number of years, we have high-graded our chemicals and refining portfolio, resulting in a more focused set of assets. Since 2020, Shell has divested 5 refineries, closed 1, and converted 1 into a terminal. We are now repurposing our portfolio to offer more low-carbon solutions to our customers. We will focus our assets in North America and China, which are well placed to enable this. This means we are initiating a strategic review of both our Bukom and Jurong Island assets in Singapore. This is mainly driven by the nature of the products they make and the demand that they serve. We will also high-grade and right-size our energy and chemical parks in Europe. This means retiring certain units and continuing with some divestment, which we already announced. The remaining parks in our portfolio will support our low-carbon opportunities, with investments like our HEFA biofuels plant, which will enable us to provide cleaner fuels to our customers. In short term, our financial delivery will be supported by the ramp-up of Shell Polymers Monaca in Pennsylvania. Given our investments to date and our focus on low-carbon solutions, our capital employed will remain stable over the decade. This means investing around $3 billion a year to maintain and manage our assets, with some capital for brownfield development only where we see attractive returns. Through simplifying and exercising discipline, we expect to generate adjusted earnings in the range of $3 to $4 billion by 2025. Now moving to our marketing businesses. To start with, I would like to acknowledge that our performance in the recent years was below expectations. Today, we are lowering our expected 2025 earnings to $4 to $5 billion. We recognize that we will need to earn back the right to grow, and therefore, we are reducing our CapEx to some $3 billion a year from $6 billion this year. We have a world-leading marketing businesses, and it's our obligation to get the most out of it. This will be our focus. And we will do this by applying value over volume across our footprint, identifying and driving cost efficiencies, and selectively growing where we see truly compelling opportunities. We have the most valuable brand in the industry, valued at around $50 billion. We're the #1 lubricant supplier and have been for 16 years running. And we serve around 32 million customers daily at our mobility sites. But how can we turn these enablers into better financial performance? Going forward, there will be 3 things we will do to improve. First, we will high-grade our network. We will retire our ambition for 55,000 Shell-branded mobility sites or stations by 2025 and drive value over volume, disposing of sites and taking opportunities where they arise, allowing us to focus on attractive markets only. As an example, we plan to exit our shareholding in Shell Pakistan Limited, subject to regulatory approvals. Shell Pakistan has a large retail and lubricants business, and we're seeing strong interest from international buyers. Second, we will pursue pace growth in key markets where we can generate high returns, like here in the US, and increase direct ownership of our retail stations. For instance, with the purchase of a Landmark, including the Timewise brand in Texas, we have more control over convenience retail. And that is where we want to keep growing. Since 2018, our convenience retail business has achieved an average growth rate of 5% through increased basket size, sales of ready-to-cook meals, and greater margins from coffee, up 57% since 2018. And third, we will grow our premium margin and expand offerings such as V-Power and premium lubricant products. Gross margin contribution of premium lubricants like Helix Ultra has increased from 39% to 45% over the last 4 years. Now let's move to EV charging. As electric vehicles become more popular, more people will want to charge on the go. And we are building an EV business for tomorrow's demand. And as New Yorkers know well, living in a city can mean no driveway and no home charging. And this is actually the situation for the majority of people in the world. And even if you do have a home charger, you are likely to need the option to topping up away from home. So that is why we are focusing on more public charging, faster charging at the right locations. We have the second largest public EV network amongst global players after Tesla in terms of country reach. This is more than 30,000 public charge points, which we expect to increase to around 70,000 by 2025 and 200,000 by 2030. To measure our progress, we have moved to a public charge point figure. And this is actually a more meaningful metric because 60% of the value resides in public charging. And in terms of the right locations, we have a major advantage thanks to our global network of service stations, which none of our peers can match. And there are also synergies with our traditional marketing businesses that we can use to make our EV charging business more profitable. As I told you earlier, our convenience retail is thriving. And there is an opportunity to generate further value by growing convenience retail in parallel with our EV offering. The average basket size spent of EV drivers is about twice that of customers who buy gasoline or diesel. China, Europe, and the US are our key markets for EV charging. In China, we saw a 25% utilization rate of our EV chargers in 2022, which was 2.5 times that of the industry average. And we continue to see higher utilization rates across our network. In financial terms, we are targeting an internal rate of return of 12% and expect to deliver an EBITDA of about $1 to $1.5 billion by 2030. Let's us move to low-carbon fuels. Low-carbon fuels, such as biofuels, are critical for sectors that cannot easily switch to electricity, like aviation, like shipping, and like heavy industry. Known as drop-in fuels, they allow customers to decarbonize without making significant investments and changes to their vehicles and machinery. Here in the US, you may have watched the Indy 500 recently. It was an historic day for Joseph Newgarden, who brought home his first Indy 500 victory. But it was also a big day for biofuels, because all the Indy 500 race cars were powered by Shell's 100% renewable race fuel, a biofuel made from ethanol. Same cars on the same track, but with a different fuel in the tank and less emissions. We expect the market for low-carbon fuels to grow, driven by stronger regulations and voluntary demand. And at Shell, we have three main competitive advantages in this area. Our first competitive advantage is that we have access to low-carbon fuels through our own production and those we buy from third parties. Through our Raízen joint venture in Brazil, we are the world's largest producer of low-carbon ethanol. In fact, if Raízen were a country, it would be the 5th largest producer of ethanol globally. Another example is our HEFA facility in Rotterdam, which will be among the biggest in Europe, and our acquisition of Nature Energy earlier this year, which makes us Europe's largest producer of renewable natural gas. Our second competitive advantage is in trading and optimizing, which gives us the ability to generate value by connecting supply and demand. Shell is one of the world's largest traders and blenders of biofuels. In 2022, we sold 14 times more low-carbon fuel than we produced. And we delivered an average adjusted EBITDA of more than $300 million in 2021 and 2022. And our third competitive advantage is that we are already starting from a strong customer base, with more than 1 million B2B customers across transport and industry. Our low-carbon fuels business is profitable today and has a pathway to greater profitability in the future. We expect an internal rate of return greater than 12% for new investments and $1 to $2 billion EBITDA by 2030. It's one thing having a vision of the future. It's quite another turning that vision into a reality. In line with our molecular emphasis, we see hydrogen and CCS as hugely important low-carbon solutions for the future, both for Shell and for our customers, especially in sectors that cannot be fully electrified, like industry and transport. The technology works. It's already in use today. But the vision I'm talking about here is a future where hydrogen and CCS are used at a much larger scale, and where these are profitable businesses for Shell. Shell is uniquely positioned today, given our natural strengths in this area, such as understanding our fuels value chain, our experience in delivering complex projects, and our technological ability. Our plan is to integrate hydrogen and CCS into our existing facilities, like at our Energy and Chemicals Park Rotterdam, allowing us to reduce our own emissions and those of the products we sell. As the market develops over time, we will unlock opportunities for future deployment at scale and leverage our customer relationships to meet increasing demand. If we look at the Netherlands in more detail, here we are building Europe's largest green hydrogen plant, powered by our offshore wind joint venture. The hydrogen produced will help to lower the carbon intensity of the energy products we make at the Rotterdam Park. And CCS also plays an important role with two projects: Porthos, where we are the anchor customer, and Aramis, a joint venture, and both are pre-FID. Projects like these could lower emissions and those of nearby industries, which make up for the Rotterdam Clean Energy Hub. However, to close the gap between where we are today and the future, stronger policy and regulatory support is needed. A good example is the Inflation Reduction Act here in the United States, which can make our investments more resilient and competitive. We also need growth in voluntary markets and more innovation, helping to scale up and reduce cost. Our plan is to invest up to $1 billion a year in hydrogen and CCS in 2024 and 2025, focusing on regions such as Northwest Europe and here in North America. Regions where we have an existing footprint, where policy support exists, where demand from customers is expected to be strong, and where we see a pathway to profitability. And that brings me to our power business, which will help to decarbonize our assets and our customers and enable our molecular businesses of the future. Well, let me start by acknowledging that we do not believe we have a distinctive competitive advantage when it comes to power generation. Where we do have a distinctive competitive advantage is in the optimization and marketing of molecules. But as the energy system continues to electrify, customers who buy molecules from us today will also expect us to offer alternatives, primarily power. In addition to serving our customers, we will need renewable power to decarbonize our assets and to enable the production of low-carbon molecules. As demand for green electrons increases, we expect the market to be tight, so we have been growing our portfolio with solar, wind, and storage assets. We must now deliver value from this portfolio, which means making disciplined and difficult choices, such as stepping back from opportunities that do not fit our strategy or do not generate enough returns. In line with this, we have taken decisions to exit projects in Ireland and France. And we are in the process of divesting our home energy retail business in Europe. We will be disciplined with our investments and will limit CapEx to $2 billion a year in 2024 and 2025. This is a net figure, so proceeds from dilutions of around $1 to $2 billion offset the gross cash CapEx figure. With this capital, we will develop our existing assets and target new opportunities where we can integrate across the value chain in key markets such as the US, Europe, India, and Australia. We will leverage our strengths in trading and optimization and our existing customer relations across industry and the transport sectors. While we expect returns in power generation to be in line with the market at around 6 to 8%, there remains upside to this in several areas, such as trading and optimization, merchant risk, dilutions, and future growth in low-carbon molecules. We expect this business to generate more than $3 billion of EBITDA in 2030. Today, we have talked about enhancing the value of our business while helping our customers decarbonize. Before we wrap up, let me quickly summarize a few key points. For our established businesses of today, we are focusing on strengthening performance and marketing and both repurposing and high-grading our chemicals and products businesses while holding capital employed stable. We have attractive growth opportunities in EV charging and low-carbon fuels, strengthening these businesses for tomorrow. And finally, with hydrogen and CCS, we are seeding growth for the energy businesses of the future, which will be supported by power. Doing this allows us to profitably help decarbonize our customers and enable Shell to deliver more value with less emissions. With that, I would like to thank you and open the floor for any questions.
All right, who wants to start? Similar faces, similar names. Okay, we'll go with Lydia, and then we go there. We've got 15 minutes of Q&A, and then we'll have a break, and then we'll have 45 minutes of Q&A with everyone, okay?
Thanks, Jack. I'll keep this short. So it's Lydia from Barclays here. Just if I add up the low carbon fuels, EV charging, and the power side, I'm getting to sort of $5 to $6.5 billion from the low carbon business. Does that sound right? And then secondly, if I'm thinking about sort of earlier about discipline and simplification, if I think about you have a lot of different businesses that you have to control, how do you drive that simplification through the organisation?
Yeah, thanks very much, Lydia. That's around right. It's around the 5 billion mark. And I think you can also see by what Wael and Sinead said that we will invest between $10 and $15 billion between 23 and 25 in the energy transition, which are very much those businesses that we allude to. Around how we drive the discipline, well, it comes very much back to first the main theme, which will be around value over volume, which is a change for certain parts of our businesses, particularly on the mobility side, where we have moved away from 55,000 sites, so not pursuing growth over growth rate. But then it's really around implementing performance simplification and discipline, which we're doing on a monthly cadence basis. So the examples I gave on the performance side, on the mobility side, taking out 500 sites per annum, which is around 4% of our company-owned, company-operated sites, so rigorously doing that. On the chemicals and products side, on the one hand, we announced the strategic review of our Singapore, Jurong, and Bukom asset, but at the same time, we will high-grade our European chemicals and products businesses, looking on a unit-per-unit basis, and that's something which is ongoing. And we've already taken some actions there. We will continue the discipline of divesting our JV shares in PCK Schwedt in Germany, as well as Miro. So those things will continue. I think on the question around discipline as well, moving the capital for marketing from 6 to 3 billion does require a lot of discipline, and it requires a lot of emphasizing on increasing the returns of those businesses. So what I'm really after in the marketing side, and while I alluded to, is increase the return on average capital employed, which I think has been lacking a bit due to many reasons, but also due to things that we could control ourselves. The other thing I would like to say is that the entire leadership team of Downstream Renewables, we had already quite some offsites, if you call, and everybody stands behind this. So we all believe in it. It's not something which we're just presenting. It's something we're operationalizing because we absolutely think it's the right thing for the company across the entire businesses that we have.
All right. There.
Hi, it's Amy Wong from Credit Suisse. Thanks, Hybert, for taking the question. And you started answering it a little bit there. It's more specifically on your marketing business.
Yeah.
I mean, in the past, you kind of talked about a IRR of 15 to 25% type kind of range for returns. And your messaging today really suggests that that's really come down quite a bit. Mind you, I do see you are trying to address improving the returns there. But could you elaborate more? Is it really the opportunity set has really shrunk? Is it your operational model in marketing that's kind of caused that returns to fall? And can you just kind of bridge where we are now in kind of getting it back up?
Yeah, on the marketing side, first I'd like to say, it's clear we have by far the most valuable brand, most recognized brand, and we have by far the best franchise or network. But I think we got a bit ahead of ourselves in terms of growth. So I think we tried to grow too much in countries where actually government interventions, particularly with high commodity prices, was higher than we might have anticipated. I recognize that, and we're doing something about it. So I'm focusing much more in areas where I can get the returns for the growth investments I have, particularly when they relate to different areas like convenience retailing. That's why we acquired Landmark here in Texas with the TimeWise brand. I think the other thing on the marketing side is over the last 2 years, of course we had COVID, of course we had the war in Ukraine, which has really led to cost of goods sold prices become very high, particularly on the lubricant side. And it's taking some time to get that through. But what I'm focusing on now more, rather than on the volume, is the value, much more premium products, more V-Power, more lubricants premiums, because the margins I can generate for the dollar investment I do is substantially higher. So it's just a recalibration around the possibility and get the most out of that business. And from that, we will see how we want to take it further. On your question on IRR, the IRR of at least 15% still stands in marketing. The only thing I'm saying, the IRR for EV charging, for example, that's 12% given the growth that we see in that area.
Cool. All right. Go here, Sam. And you, Thijs. Yeah.
Hi, it's Sam again from Wolfe Research. On RNES, because of the trading business that dominates it today, it's been pretty volatile in cash generation. There was a big working capital outflow last year, and then some of that's coming back this year. You know, it's not so asset laden today. So as you develop assets in that segment, do you expect cash flows to take on more of a ratable pattern, or is trading always just going to be a big part of it, and it's going to be hard to model on that side?
Well, if you look on the power trading side, we're actually the third largest power trader in the US. And if there's one thing around being part of, of our global trading and optimization is we know how to manage that volatility. I think if you look at the asset generation side, I think what I'm saying is that being purely in asset generation, renewable asset generation, I don't see any big competitive advantage for us. So what I need to do is I want to have renewable asset generations which are tied in that I can do trading and optimization around it and actually bring those electrons to B2B customers. The regions where I can do that is the US, is Europe, is India, and is Australia. So I'm not going to have an approach, I'm going to look everywhere in the world. I'm going to concentrate in those areas that really play to my strengths. And that is what we will develop over the next few years.
Right. Go to Thijs here.
Thijs Berkelder, ABN AMRO, Oddo BHF. Questions on EV charging. Can you maybe indicate where capital employed in EV charging is right now? Whether your IRR and EBITDA targets only include EV charging, but also include your, let's say, your shopping margins. Most shop sales probably now in the petrol station shops. Can you give an indication on what is currently the electricity volume sold in your EV charging business, and what is the percentage China in that volume?
First, I think what we acknowledge is this could be a very exciting business for us, EV charging. It's very complementary to what we do. Actually, in our top 20 markets, probably 90% of the population lives within 15 to 20 minutes of a current Shell mobility site. So that leads itself extremely well for EV charging in those areas. It's something we know well. To the example I gave is we look at an IRR of 12% for EV charging, which we're running for, and the EBITDA will be 1 to 1.5 billion by 2030. We don't say exactly how much that comes from convenience retailing. I think it's predominantly what we can do on the charging itself, but the convenience retailing is extremely important because that's what attracts customers. So it's not around just recharging your car, it's about also recharging yourself. And the examples I gave is that from the data, what I look at, we're now the second largest global player in EV charging after Tesla, is that an EV customer spends twice as much on the convenience retailing than a normal customer. And the example we gave in China is that EV customers actually come twice as much as a conventional customer for an internal combustion engine. Why we're emphasizing China as well is because it's really taking off. I think this year China will sell around 8 million EV cars in a very urbanized environment. So fast charging really plays to our strengths. Brand plays very much to our strengths. So I'm very excited about the opportunities there. But the opportunities in other areas are very large as well. Some of you, I don't know if you've gone to, but for instance, I've gone to the Fulham EV site, which we have in London. Used to be 100% petrol, is now 100% fast charging. And if I look at the utilization rates there, it's above 40%. So the return cycle of that investment has been tremendous, as well as what it's doing for the neighborhood and the convenience retailing of that. So those, I'm starting to address some of your questions, and I'm sure we'll have more discussions later on them.
All right, last question. Well, Lucas, put your hand up first.
Thanks very much. And sorry, Lucas Herrmann at BNP Paribas Exane. And hi, but thanks for being very frank and open in terms of the comments around the business and how it's performed and where it's going. Two, if I might, just if I start with chemicals, just to try and better understand, I know we have issues, well, there are issues around the startup of Monaca, fine, put those aside. But if you look at the business, ex-Monaca, I guess, some of the assets in Asia, what's the underlying profitability been like? So in part it's asking, how challenging are the targets that you're now setting yourself for improvement relative to a base, if I start taking out the problem children? And the second question, if I might, is just on biogas. And I'm trying to understand why it is that you've chosen Europe as a playground, not least given your comments around IRA, not least given Shell's competence in trading, why you'd focus on a market which is more disjointed, where pricing's typically tied to electricity and electrical contracts, and where the opportunity really seems a little more constrained and fragmented.
Thanks, Lucas. A couple of things on the chemical side. So if you look at our chemicals capital employed, it's close to 30 billion, it's 28 billion. And indeed, a large part of that is Shell Polymers Monaca. So if we take that aside, it will be operational in Q1 of next year. Then you look at the remaining capital employed, and you will see that around 20% of what's remaining is tied into Singapore. So it's the Bukom and Jurong. So where we now at the strategic review. Then you look at the remaining assets. You have China, where we have our joint venture Nanhai, or CSPC, which is absolutely top quartile. We have particularly the Gulf Coast here in the United States, where we are the #1 leading technologies with linear olefins, where we make our higher olefins and detergents, which is very robust also from a return standpoint. Then we have Canada, which is tied into Scotford, and in Scotford we have an advantaged position given the dislocation in the markets between the evacuation of products. So that leaves Europe. So, and in Europe, what I've announced today is that we will do a review unit by unit to ensure that we get the returns into a better place. The one thing you do have to consider in Europe is that I cannot look at chemicals alone. It's fully integrated with my refining business, but particularly the value it gives me for trading and optimization. So the chem feed business I have in trading is actually a very attractive business. At the same time, these are also the assets where I want to provide low carbon products for our customers. So 2 examples. If I look at Pernis Hefa, which will be the largest biofuels plant in Europe, or one of them, I can produce sustainable aviation fuel, I can produce renewable diesel or bio-naphtha. And the bio-naphtha can go to the chemical industry, where now many brand owners on the chemical side are paying premium for those products. So that's how you have to look at them to tie them in. With the carbon capture and storage in Portos, I can further reduce the carbon intensity of that product to basically have a net zero chemicals proposition to those customers, which is actually quite exciting in itself. Then on your question on why Europe for nature energy. Well, we are, as I mentioned, a very big blender of and trader of biofuels. We actually blend and sell 14 times as much as we produce. We actually saw and see a lot of interesting propositions for renewable gas in Europe because we have such a strong marketing position. So I can provide renewable natural gas to our commercial road transport business, where we're actually very strong position in Northwest Europe immediately. First of all, on the mobility sites we have, or directly to customers, and then I can use trading and optimization to work with the flows. Does that mean I'm not looking in the United States? Quite to the contrary. We have a very big biofuels business in the United States as we speak. Nature energy for us in Europe was a very attractive proposition, and it was available at that time, and I'm very pleased we did that.